Okay, so you want to own a small apartment building. In your head, it's simple. Buy it, collect rent, let the mortgage take its bite, keep the rest. Here's what nobody tells you first. Once that building has 5 units, the bank stops asking about your salary, your credit, your job, none of it. It only cares whether the building can pay back its own loan. That should make this the safest debt in America. It doesn't. By the end of this video, you'll know exactly what it costs to get into this business at 3 different price points, where the money actually comes from once you're in, the hidden system built into the building around your tenants that most owners never even notice, and why a loan banks treat as nearly bulletproof still produces some of the ugliest bankruptcies in real estate. A small apartment building isn't really the business of collecting rent. It's a different business wearing rent's clothes, is a clause that can turn a debt with your name nowhere on it into a debt with your name on everything you own. 5 units is the line that changes everything, and almost nobody buying their first building knows it exists. Below 5, you're getting a residential mortgage like anyone buying a house. At 5, you cross into commercial lending, and the building gets appraised the way a business gets valued, off its income, not off what the house next door sold for. At the low end, you're looking at a 6-unit workforce building in a secondary market. Midwest, Rust Belt, small southern city, running somewhere around $100,000 to $120,000 a door, so call it $650,000 total. Commercial lenders typically want 20 to 30% down on a building this size, which puts your entry check somewhere between $130 and $195 before you've paid a single closing cost. What you're actually buying at this tier is old bones, a 1970s roof, 1 boiler doing the work of 12 furnaces, and tenants paying rent that hasn't kept pace with the neighborhood. Step up to a stabilized 20-unit building in a growing metro, and you're in $2.5 to $3 million territory.
This is where Fannie Mae's small balance apartment program starts to make sense. Loans from roughly $1 million, up to 80% of value, non-recourse. Your down payment is smaller as a percentage, but the total check is bigger in dollars. And now the lender wants 90 days of stable occupancy above 90% before they'll even quote you a rate. At the top, you're not buying a building, you're buying a platform. During the pandemic-era boom in cheap debt, a Houston-based investor named Jay Gajavelli, running a firm called Apple's Way Investment Group, borrowed nearly $230 million to acquire 4 aging apartment complexes, totaling more than 3,200 units. That's the scale where a single signature moves $250 million. And the $230 million is exactly where the math in this video starts getting dangerous. We're not telling you why yet. Now, the costs nobody mentions on the listing page. First, the lender doesn't just check the building's income. They order a property condition assessment, an engineer's report grading the remaining useful life of the roof, the boiler, the parking lot, down to the year. If that report finds 5 years of life left in a system, the lender can force you to fund a repair reserve at closing, sometimes tens of thousands of dollars, before you've collected $1 of rent. Second, insurance. Multifamily insurance premiums, adjusted for inflation, have risen more than 75% nationally over the past 5 years. And Federal Reserve researchers found that for every extra dollar an owner pays in insurance, net income falls by about 72 cents. Almost none of it gets passed through to rent fast enough to matter. Third, and this is the fact worth remembering, in many states, your purchase itself triggers a property tax reassessment. The building's tax bill was set by the previous owner's purchase price. The moment you close at a higher number, the county quietly rewrites your expenses before you've even changed the locks. So where does the money actually come from? Not the rent check, if that's just the raw material. Picture a unit renting for $1,200 a month.
Your share of the mortgage payment on that single unit might be $950. The gap? $250. Looks almost insulting for the risk you just took on. That's 1 unit, 1 month. Now multiply it. 12 units, 12 months, 30 years of ownership through refinances and rent increases, and that $250 gap becomes the engine of a portfolio worth millions. Small, repeated compounding. That's the whole trick. And it's the same trick behind almost every fortune built on real estate. Here's where it gets structurally strange, though, in a way that separates this from owning a single rental house. The loan you took out to buy this building wasn't sized off your income.
It was sized off something called net operating income, NOI for short, which is just the rent and fees the building collects minus what it costs to run the place, before the mortgage payment is even subtracted. Lenders divide that NOI by your annual debt payment to get a number called the debt service coverage ratio, or DSCR. And most want to see 1.20 to 1.30, meaning the building has to generate 20 to 30% more income than the mortgage actually costs. Say that out loud, and it sounds like conservative banking. What it actually means is the building borrowed the money to buy itself. You supplied the down payment and your signature. The building supplied the collateral for its own purchase. And once you understand that, every dollar of income on the rent roll stops looking like a paycheck and starts looking like an input to a formula. Base rent is usually 80 to 90% of total revenue, the obvious part. The rest comes from a couple of quiet side businesses most tenants never think about. Utility reimbursement through a system called RUBS, worth another 3 to 5%, plus parking, storage, laundry, and pet rent worth 2 to 4% more. Nearly pure profit, since the infrastructure is already built and paid for. Here's the twist most new owners never see coming. Buildings don't sell for a multiple of their revenue.
They sell for their NOI divided by something called a cap rate, sitting nationally around 5 to 6% right now, drifting towards 6.5 to 8% on smaller buildings in secondary markets. Run that backward and something wild happens. At a 6% cap rate, every extra $1 of annual NOI adds roughly $1,667 to the building's sale price, not $1.16 and change. That single number is why a landlord will fight you over a $30 a month rent increase on a 12-unit building. It's not pettiness. It's $4,320 a year in extra NOI, which at a 6% cap rate just added roughly $72,000 to what the building is worth on paper without laying a single new brick. Cash flow, the actual paycheck, is just NOI minus debt service, and every reserve fund, tax appeal, and well-timed refinance in this business exists to nudge one side of that one line. You've probably stood in the parking lot of a building exactly like this one, waiting for a friend, and never noticed what you were looking at. Every visible feature of a small apartment building was chosen for a financial reason, not a comfort reason. Start with the meters. If you've ever wondered why some older buildings have one shared water line for the whole property, while newer ones sub-meter every unit, that's not an accident of construction era. It's a direct NOI decision. Sub-metering, or billing tenants back through RUBS, the ratio utility billing system we mentioned a moment ago, can shift thousands of dollars a year in operating expense off the owner's books and onto the rent roll without technically raising anyone's stated rent. Unit mix isn't random either. Developers deliberately overweight studios and one-bedrooms in workforce housing because rent per square foot reliably drops as unit size grows. A studio commands meaningfully more per square foot than a two-bedroom in the very same building, floor for floor. More small units means more total rent per square foot of building, full stop. Now, the group most owners get completely backward: tenants who pay rent through a housing choice voucher, commonly known as Section 8.
New owners often assume voucher tenants are the riskiest tenants in the building. Experienced small building owners frequently treat them as some of the most valuable for one specific reason. The government-subsidized portion of that rent is paid directly to the landlord by the housing authority on schedule, regardless of whether the tenant's personal finances have a bad month. In a business where the entire loan is underwritten on the reliability of collected income, a guaranteed partial payment from a federal program is worth more than it looks like on the rent roll. It's a genuine reversal of the outsider's assumption, even if it doesn't apply to every market or every voucher tenant equally. None of this is charity, and none of it is cruelty either. It's just architecture built around one number. The meters aren't split because it's fairer. The unit mix isn't studio heavy because people love studios. Every visible decision in the building you're standing in was made in a spreadsheet years before it was made in concrete. And it was made to move NOI, not to serve you. If the income side is this engineered, this reliable, this mathematically clean, why do owners of buildings exactly like this one keep going broke? The honest answer is everything else. Start at the top of the expense stack. Property taxes, which we already touched on.
A reassessment at your purchase price can add tens of thousands of dollars a year the moment you close, sometimes before your first rent check clears. Insurance, up more than 75% per unit nationally over 5 years, and rising fastest in Florida, coastal Louisiana, coastal Texas, and the Southeast. Then it gets specific in ways no one budgets for. Elevator inspection contracts, boiler certifications, lead paint disclosure and remediation costs in pre-1978 buildings, bedbug treatment protocols that can run thousands of dollars per unit and have to be repeated if the tenant next door is also infested. And here's where the hoax teaser from the start of this video finally pays off. Most owners assume the loan they signed is non-recourse, meaning if the deal collapses, the bank can take the building, but not your house, your savings, your other assets.
That's true, right up until it isn't. Nearly every commercial multifamily loan contains provisions the industry bluntly calls bad boy carve-outs, specific triggers that can convert a non-recourse loan into full personal liability. Committing fraud on your loan application is the obvious one, but depending on the exact loan document, the list can also include failing to pay property taxes or insurance premiums on time, misappropriating rent income for anything other than the property's own expenses, filing for bankruptcy without lender consent, or raising subordinate financing the lender never approved. In some of those documents, missing a single insurance or tax payment during a genuine cash crunch is enough to trigger one of these clauses. And on that specific point, the protection you thought you had on your personal assets simply stops applying. Read that again. In the wrong loan document, you didn't have to commit fraud. You just had to be late. That's the whole trade this business is built on, and it never gets said out loud in the listing description. Guaranteed base rent against a stack of unguaranteed everything else. Taxes that jump the moment you buy. Insurance that climbs every year regardless of your management. And a loan structure that quietly holds a trap door onto your personal net worth, waiting for one missed deadline. Small apartment buildings don't usually die from bad tenants. They die from bad financing structure and neglect. And both patterns repeat so predictably, you could set a clock by them. The first is floating rate leverage. During the pandemic-era boom in cheap debt, Jay Gajavelli's Apple's investment group closed on nearly $230 million in loans to buy those 4 Houston apartment complexes, more than 3,200 units, all built before 1981. The debt was floating rate. When the Federal Reserve began raising rates through 2022, the interest rate on at least one of those loans climbed from 3.4% to around 8%. According to loan data reported by the Wall Street Journal, Apple's way couldn't keep up.
Starting in April 2023, the lender foreclosed, first on 4 properties, then a 5th, a complex called Cabo San Lucas, bought using a separate $62.52 million loan issued in December 2021, back when floating rate debt still looked cheap. That 5th property sold at public auction for $50 million. The rule this teaches: when your debt is floating and your rent is fixed by a 12-month lease, your reliable income and your monthly payments stop moving together, and the gap between them can eat your equity faster than any bad tenant ever could. The second pattern is deferred maintenance, and it's less dramatic but just as fatal. It's the decision to skip a $2,000 roof patch this quarter because cash is tight, then skip it again next quarter, until water intrusion rots the framing, mold spreads into 3 units, and what would have been a 5-figure repair becomes a 6-figure remediation, with tenants relocated and units sitting vacant for months. It's the household version of ignoring a check engine light until the transmission needs replacing, except the car here has 12 families living inside it, and a city inspector who eventually shows up. In the Apple's Way case, the city of Houston documented over 100 habitability violations at Cabo San Lucas alone before the foreclosure. Mold, pest infestations, broken plumbing, malfunctioning appliances. The physical evidence of years of deferred repairs stacking up underneath a building that on paper still looked like it was cash flowing. Same company, the same 18 months, 2 separate ways to lose a building. One from the financing side, one from the physical side. And both were visible years before the foreclosure notice ever arrived. Here's who actually wins in this business, and it's a less exciting answer than you're hoping for. It's not the biggest borrower, it's the most boring one.
Small balance commercial lenders who specialize in 5 to 20 unit buildings describe the profile openly. These are individual owners buying in a gap that's too big for a residential mortgage and too small to interest institutional capital and Wall Street landlords.
Which is exactly why the segment still rewards patient, hands-on individuals instead of large funds. Strip away the details, and their playbook comes down to 3 disciplines. Lock a fixed interest rate for the longest term you can get, even if it's a little higher than a floating one. Appleway's Ghost is a permanent reminder why. Hold real reserves, months of operating expenses sitting in cash before you take a single dollar out as a distribution. And never borrow to the maximum a lender will offer just because the lender is offering it. The leverage that makes the good year spectacular is the exact same leverage that makes one bad year fatal. None of that requires genius. It requires understanding what actually separates the winners from the wreckage. The winners aren't the owners who maximize cash flow. They're the owners who maximize the amount of time they can survive a bad year. And if that reframe is useful, it's worth subscribing, because the next building we open the books on tests that idea to its limit.
One rental unit is a job you do after work. 12 of them run this way is a business that runs without you. Let's step back for a second, because there's a real contradiction sitting in the middle of everything you just heard. The lender treats this building's income as reliable enough to bet $250,000 on without ever checking your paycheck. And yet, buildings just like it, run by experienced people, keep ending up in foreclosure court. Both things are true at once, and here's how. Compare it to the simplest business on the block: a laundromat, a corner store, a single rented out house. Those businesses can shrink slowly. A bad month is just a bad month. A small apartment building can't shrink slowly because it's wearing 30 years of leverage, borrowed against a rent roll that only has to slip for a few consecutive months before the DSCR. The whole loan was built on breaks, and the bank's patience runs out on a fixed schedule, not yours. So the paradox isn't really a paradox. It's a trade stated honestly for the first time in this video.
Guaranteed rent in exchange for unguaranteed everything else. The interest rate, the tax reassessment, the insurance renewal, the roof. The mechanism that makes this loan safe only ever covers one half of the equation. Nobody underwrites your tax bill. Nobody underwrites the Fed's next move. The building's income was never the risk. The financing wrapped around it always was. And once you've paid that risk down, once the debt is manageable and the building is stabilized, what's actually waiting on the other side of it is worth understanding in real numbers. So how much would you actually walk away with if you did all of this right? Take the modest path first. You buy that 6-unit building for around $650,000, put $162,500 down, and finance the rest through a 25-year commercial loan. After debt service, taxes, insurance, property management wanting roughly 9% of collected rent, and a maintenance reserve, at the kind of DSCR a lender would actually approve, something near 1.25, you're clearing somewhere in the neighborhood of $9,000 to $11,000 a year in actual cash flow. Call it 6% on your down payment before you count principal paydown and appreciation. It's not exciting, it's not a story you'd tell at a party, but it survives recessions, insurance spikes, and one bad tenant because the debt is fixed and the numbers were never stretched to begin with. Boring, but alive in year 20, which is more than most leveraged real estate ventures can say. Now, the ambitious path. You start with one small building, refinance it conservatively every 5 to 7 years as equity builds, and use each refinance to fund the down payment on the next one. The same small balance gap strategy from Block 2, just repeated patiently for a decade or two instead of risked on a single leveraged bet. Here's the payoff worth remembering longer than any other number in this video. At real scale, the apartment building stops being the product. The product becomes the debt itself. Decades of tenants slowly paying down a mortgage that converts dollar by dollar into your own net worth, while the building's value compounds against a cap rate that rewards every extra dollar of NOI at roughly 16 to 1.
Sam Zell is proof of how far that same mechanic can travel over enough time,
not proof that every 6-unit building ends up there. He started managing student housing apartments as a University of Michigan undergrad in the late 1960s, then founded Equity Group Investments in 1968, 25 years and a completely different order of institutional capital. Later, he took Equity Residential public in 1993. By the time he died in 2023, it had grown into a $31 billion apartment owner, and his personal fortune stood at $5.2 billion. Same underlying mechanic: rent paying down debt, debt converting into equity, just stretched across 5 decades, and a scale almost nobody watching this will ever operate at. Most owners land somewhere between those two paths, and that's not a failure. It's the honest median outcome of a business built on patient leverage instead of luck. So no, the bank never checked your salary, your credit score, your job history when you bought this building. It didn't need to. It was never really lending to you. It was lending to the building, using the building's own income as collateral for its own purchase. And you were just the person standing next to it, signature ready when the money changed hands. Okay, so now you know what you'd actually be signing up to.